from exactly 7.5 to right now a 9.0 mark, actually from 8.5 to 9.0% at the moment. And this is the third time within a space of less than 3 months that the Central Bank Monetary Policy Committee is sitting and raising the central bank rate, definitely due to the rising rates of inflation and many other factors that are currently hitting the economy. And of course, we will later on look at the stock market as well, looking at how the stock markets have been able to work out for you, and those that have been able to get some gaining and losing on the stock market. But on top of the stories making headlines right now is the fact that the Uganda Central Bank has increased the central bank rate for the third time in a row. And we can see now the rate at 9.0%. That was according to Dr. Michael Etinji Ego, who is Bank of Uganda's deputy governor at the moment, as of course we still continue to face pressures due to inflation, pressures due to the weakening of the shilling against the dollar, and also dry weather conditions in several parts of the country, and definitely looking at some of those as the factors that could have influenced this. What does this mean for Ugandans? What does it mean for you and me? In the investment world, what does it mean for the banks? What does it mean for you as an investor? Definitely, if you want to catch more of that, you need to stick around and get to enjoy the show until the end. My name is Anthony once again, and you're most welcome to the show. You can catch our conversations on Twitter at Smart24TV, that's our handle, and my personal handle is Anthony Sebale. And of course, you can also catch our channel on YouTube and leave a comment in the comment section. That is at Smart24TV Live, and definitely we'll give you some responses as regards to that particular comment you might have given. Thank you very much for staying tuned with us. Of course, is definitely one of the most interesting shows of the week, financial markets. Now, let's look at this central bank rate in a very critical dimensional way. We are looking at it in the different facets. First of all, we saw that just recently the interests on several loans, and of course by commercial banks, has also increased because of the increase in the central bank rate. Because how it really works is the fact that banks or commercial banks are getting money from the central bank at a specific interest rate, which is known as the central bank rate. And this is the rate at which we are looking at for the government of Uganda being able to set a certain threshold, whereby this is the threshold for lending. In other words, it drives the lending rates of other businesses, that is to say money lenders, banks, and so many others. And looking at it very simply, the fact that the central bank is mandated to be able to control any, for example, inflationary problems, people, maybe things that to do with foreign exchange problems, maybe you're looking at depreciation of the currency. The central bank is mandated by the government to be able to do something about most of these things, because it's the custodian of the money of the country, the custodian of, for example, what people trust the central bank to be able to print money whenever they feel like they should print more money, to hold or withhold printing money whenever they feel like, during this time we're not supposed to have printing of notes or new notes. And so the central bank during this time has been one of the most looked at institutions to see that the inflation we are seeing, which is simply the steady rise in prices or the average rise in prices overall on commodities such as food, on commodities such as fuel, and so many others, has been, of course, put to the Bank of Uganda to task it to see that they do something to control this inflation. Now, what does the central bank rate No. And what does it use it for? The central bank rate knows that one factor that can be able to regulate inflation, leaving other factors constant, is the fact that we need to reduce the money in circulation. And this money in circulation definitely just refers to the money that you and I are using to purchase goods, and it determines our purchasing power, how much purchasing power you have as an individual to be able to buy or afford certain commodities. And the more they reduce this purchasing power, the more they reduce this money that is floating in the economy, the more they fight the problem of inflation, because then money becomes more scarce, and the more scarce money is, the less the demand on the goods that are available on the market, and the less the demand on the goods that we have on the market, definitely the lower the prices, because as you will see that because people are not willing to buy those goods at those high prices, their prices could shift downwards. They're not trying to make people poor or trying to see that people don't have money to rely on, but they're only trying to make sure that the economy is balanced. The demand and supply of goods, the demand and supply of money is equal at a certain equilibrium point where we have a balance between that demand and supply. And so what does the central bank rate really do to reduce this money in circulation? By raising the central bank rate, you're going to find that these banks, the commercial banks that have been getting money from the banks, central bank, will get it at a higher interest rate. Meaning when they get this money at a higher interest rate, the clients of those banks who would want to get loans, maybe salary loans, maybe any sort of loan, mortgage, and so on, will have to get them still at a higher interest rate. Now, what does that mean? That changes the behavior or the economic behavior around the people or the clients of these commercial banks. And these commercial banks get to lend at higher interest rates. And this means that less businesses will be able to afford paying for these loans. Take a look at a loan of over 15% monthly interest, or okay, let's say per annum, 15%. There are very few businesses that can take such a loan because it is quite expensive. Look at the interest, yes, 15%, 16%. Those are very pretty much high interest rates, because still the banks have to make a little money, and then they have to pay back this money back to the central bank rate, at a given interest. So they shift the interest to their clients, and therefore this changes the borrowing tendencies or the borrowing behavior of the various investors that we have on the market, or the clients that are using these banks. Definitely, usually business owners, people are trying to borrow money for school fees, people are trying to borrow money for different things. There's hardly any business that doesn't have a single loan. At least businesses have loans here and there, not in a bad way, but in a way to grow their businesses. Now, definitely when the interest rate goes up and the central bank rate has gone up, because of the central bank rate going up, then you will see that less and less people will be able to afford borrowing this money from the commercial banks. And this affects mainly the private sector businesses. Those are businesses of individuals, looking at schools, looking at shops. You look at retail shops, you're looking at wholesale shops, you're looking at various businesses, food, hotel and accommodation, and all these other businesses that are going to be affected extremely by the huge interest rates, which they cannot afford to pay for. Now, when that happens, definitely there will be less lending by the banks. Less lending by the banks means definitely less money in circulation, and this reduces our purchasing power as individuals, and then later on inflation eventually is expected to go down. And this is exactly what the central bank is doing by introducing an increase in the central bank rate. The central bank rate early this year began at 6.5%. In a few months into the year, around the month of April, May, we had the central bank rate increased to 7.5%. And then later on, within a space of less than a month, the same rate and under the same policy, monetary policy committee meeting, which usually happens every month, of course, sometimes not really monthly, but the central bank definitely has a monetary policy committee meeting, and especially during this time, they need to have even more meetings to see how they can tackle this inflation. Within a space of less than 1 month, they sat again and raised the central bank rate by 100 basis points to 8.5%. And that was the last recent one. But now, on Friday, still in a policy committee meeting, after sitting, this meeting also still decided to raise the rate to over 9.5%. 9.0%. That is about 50 basis points of increase. Now, Dr. Michael Atingi claimed that the Bank of Uganda saw that the economy and, of course, the businesses continue to face very strong cash cost push inflation pressures, and from the external environments, also due to dry weather conditions that the country is experiencing, and the exchange rate depreciation, domestic demand. And now the headline inflation, a measure of the annual changes in the cost of living, rose to 7.9% in the month of July. That was from 6.8% from the previous month of June. And the inflation, the spike in inflation was saw the committee meeting, as we have seen, rate by a percentage, of course, raised the rate by a percentage. And that was the highest hike since 2018. And in June and again in July as well. Now, last month, Bank of Uganda held its first unscheduled monetary policy committee meeting on the back of soaring commodity prices occasioned by supply chain disruptions that are caused by the Russian-Ukrainian invasion. Now, Mr. Atingi last Friday said that the central bank rate forecasts inflation to range between 7.0 and 7.4% for the rest of the year. And the economy is projected to expand between 2.5% to 3.0%, a slower pace compared to the earlier estimated 4.5% this year. Overall, economic growth prospects have been dimmed further, with increasing risks of a global recession and a weaker consumer and business sentiment as inflation and commodity prices continue to erode households and businesses' incomes and financial conditions tighten. Now, the monetary policy stance has seen the cost of funds rise as commercial banks increase their lending rates, restricting private sector borrowing. Definitely, that is exactly what compounds the problem. The private sector is being hurt in this case. But now let's look at the other side. What is the good side of this central bank rate being raised? Of course, number one, they will definitely control the inflation. And inflation, as we have seen, is the average rise in the cost of living, annual average rise in the cost of living. And at the moment, we are looking at over 6.8% of the inflation right now. The target for Bank of Uganda initially this year was 5%. That was the threshold. And of course, when we exceeded that threshold, they came in and tried to do something. Then that is after an impromptu meeting, of course, of the policy committee, and then monetary policy committee. And then you have the inflation still rise further to over now 6.8%. And they're saying, Dr. Michael Atingi says they expect this inflation rate to keep within 7.4 to 7.9% this year as we move forward. They've seen also a slow economic growth pace by over between 3.0 3.5%, and the projected was 4.0 to 5.0%. So still we are falling short in terms of economic growth. But what's the good side, really, besides having inflation controlled by using this increase in the central bank rate? Now, on the show here, we definitely talk about the financial market segment known as the debt instruments. And these debt instruments are those financial instruments or securities that are concerned with debt or borrowing. Now, as we know, government has a budget every single year which it puts up, and government looks for funds to finance this budget every year in terms of, number one, the revenue collection, that is through taxes. Number two, we have also the borrowing, foreign borrowing, where government goes to other countries and borrows money. Number three, we have domestic borrowing, and this is the beautiful part, that the domestic borrowing, which is divided into the treasury bills and the treasury bonds, is definitely coming in at a coupon rate. And these coupon rates, we all know, are dependent on the central bank rate as well. Why? Because central bank rate is aimed at controlling inflation, seeing that there's control of money in circulation. Now, whenever government wants to pull out money from our pockets, it wants to have money from our pockets back into maybe their reserve or maybe into the economy, they would definitely increase this rate. Because remember, you're lending to government at a certain interest rate, which you're going to get back. And so to attract you to borrow more money, to lend more money to government, they will increase their rate. As we know, the treasury bonds are long-term instruments, over 3 years and above. We have 3 years, we have 5 years, 10 years. We also have 15 years and 20 years worth of treasury bonds. And during this period, if you're holding a certain bond, you're earning a simple coupon or interest on that money that you're able to borrow to lend to government, and this interest comes in every after 6 months. So if the interest rate or the coupon rate on the bonds is going to increase, definitely you're going to buy more bonds, and definitely you're going to earn more out of a bond. So why am I saying all this? Because this is an opportunity for you to lend to government and get back at a huge interest rate. Because, as I said, right now, maybe yes, they haven't, of course, auctioned some of the bonds, but in a very short time, when they issue these bonds, definitely they are going to come in at a very attractive interest rate. And this is exactly what you want to take advantage of. I told you that bonds and bills are some of the safest or the most risk-free assets in which we can invest as investors, even safer than the stock market. Because the stock market, we don't know really what may happen. The next day, companies may all lose their value, or they may all gain value, but we don't know. We are not sure, and we are not guaranteed in any way of our value on the stock market. However, when you buy a bond, when you buy a bill, you are at almost 100% sure that government, first of all, will not default, and secondly, the interest rate is fixed. That's why some of these are called fixed income securities, because you have a fixed rate that comes in at every particular interval. 6 months in Uganda, for example, every 6 months you have that rate coming in, and this rate is fixed, with government, of course, giving you back your initial deposit at the maturity of the bond. Now, that is a list. I just wanted to give you a little look at the list of treasury bonds that are listed right now on the Uganda Securities Exchange. Of course, you can visit the website and have a look yourself. But that, for example, you look at that bond on the very first bond up there, UG12. You're seeing that UG12 H2 0109125. That is the international securities identification number of the bond, and you can see the issuer's name is the government of Uganda, and the type is a bond, that is B, and the issued number of shares, you're seeing that there's 100 billion on that bond, and the issuing date was 2016. That is in the month of September 21st. That is the date. And then the rate was 16.5. And that bond was going up to 2021, the 21st of September, meaning it was roughly 5 years, a 5-year bond. And that was issued at 16.5% interest rate. Now, there are so many others, as you can see in that column. You have 200 billion, you have 100 billion, you have 156 billion, you have 145 billion, and so on and so forth. And they're all listed on the Uganda Securities Exchange. Now, when you have your money that you're not going to need in the next 5 years, you can put that money in this bond. Definitely, you don't have for example, the benefit of being able to sell, to buy at any price of maybe 6 shillings like on the stock market, because bonds are bought in units of 100,000. You don't have to buy the entire 200 billion bond, but with a unit of 100,000, you can buy a single unit, and then you can buy another unit at 100, that makes it 200,000. You can buy 3 units at 300,000, and you can buy 10 units at a million, and so on and so forth, as much as you can buy. When you do that, you definitely get your return every 6 months. However, still there's an option that in case you want to get back your initial deposit before the maturity of that particular bond, you can still come back to the exchange. That bond is listed again, and people come and buy your bond, meaning from then on, after getting your initial deposit, you no longer earn the coupon, and the coupons go now to the person who has been able to buy the bond again. Simple, very, very simple. Lending government, coming back with interests, and definitely giving you value for your money. This is an opportunity that I would want you to enhance, to actually harness. And definitely Bank of Uganda is giving you this chance as well. You can go through your central bank, you can go through the exchange, you can go through brokers, any licensed person under the Capital Markets Authority or under the Bank of Uganda can be able to issue you this bond. But all I'm saying here is you should look out for these right now, because they're one of the assets that are coming in as very, very profitable within the financial markets world. We're going to take a very quick breather, and when we return, I will wind up this for you and also get to look at the stock market as it played out last Friday. Stay with us.
Smart 20